With an advertised 4.2% return on your first 20k, Broker Finance is the latest investment product that offers fast returns on your money. With such an attractive return, the question to ask is, what is the catch? Well, in this video, I'll be highlighting 4 things you should note before putting your funds with Broker Finance. The first one being that funds with Broker Finance are not capital guaranteed. As Broker Finance is a fund management company licensed by MAS with a Capital Market Services license, naturally the soft for the SDIC, which covers up to $100,000 of your funds with individual banks. Thus, Broker Finance should not be seen as an alternative to fixed deposit, as they differ in both risk profile and safeguard measures. So with no capital guarantee on your funds, how safe is Broker Finance exactly? This can be broken down into 2 parts. Number 1, how Broker Finance manages customer funds, and number 2, how Broker Finance invests your money on your behalf. Let's start with the first portion. Based on Broker Finance terms and conditions, customer funds are held separately via a custodian, which is All Funds Singapore branch, which is also a MAS licensed financial institution. This means that any customer funds invested in Broker Finance are held separately for the company's own cash balances. Thus, in the worst case scenario that Broker Finance goes bankrupt, your funds will still be safe with the custodian. However, access to your funds will be limited or restricted until legal proceedings or any acquisitions from third parties are concluded. On the second portion of how Broker Finance invests customer funds, they basically put your money into bond funds. Currently, Broker Finance invests customer funds into 3 separate bond funds, namely the Dimension Global Short-Term Investment Grade Fixed Income Fund, the Fullerton Short-Term Interest Rate Fund, and finally the UOB-AM United SGD Fund. Do know that there will be a 4th bond fund that Broker Finance will put customer funds into, namely the Diamond Global Fund. However, as of filming this video, my funds with Broker Finance are still invested in the 3 earlier mentioned bond funds. If you look at the bond holdings of individual bond funds, you notice that most of it are AAA rated to BBB rated corporate and government bonds. A majority of these bonds mature within a year, which thus explains the low weighted average maturity of these bond funds. From a credit rating perspective, the bond funds that Broker Finance invests in are relatively low risk. However, this does not mean that potential capital losses will not occur, as the value of customer funds are still tied to the net asset value of these 3 bond funds. Nevertheless, it should be said that any potential capital losses will be covered by the 4.2% returns, which I'll talk about next. As customer funds with Broker Finance are invested in bond funds, in normal circumstances, the returns of customer funds will mirror that of the average return of the 3 underlying bond funds. However, in Broker Finance's case, for this 4.2% return, there is 2 scenarios to consider. Number 1, the underlying bond funds return more than 4.2%, and number 2, the underlying bond funds return less than 4.2%. Let's start with the first scenario, whereby the underlying bond funds actually return more than 4.2%. In this case, Broker Finance will keep anything that's above the 4.2% return. So for instance, let's say the underlying bond funds return 5%. Broker Finance will keep 0.8% and distribute 4.2% to its customers. Now for the second scenario, whereby the returns on underlying bond funds is less than 4.2%, Broker Finance will top up the shortfall with their own company cash balances. Do know that this top up to the 4.2% return will cover both capital losses and lower returns from the bond funds during the qualifying period, as long as the capital is 20k or below. This qualifying period will be until 31st December 2024, or until Broker Finance amasses an AUM of 500 million Sing dollars, whichever is earlier. Also, do not Broker Finance reserves the right to amend this qualifying period or the qualifying threshold at any time they wish. Now that we know how the 4.2% return is generated on our funds, the next consideration to have is how often or how frequently Broker Finance has to top up to fulfill that 4.2% requirement. For this, we look at the underlying returns of the 4 bond funds. Now if we look into the 4 bond funds, only half of them have a 1-year return of at least 4%. If we were to base the average underlying return of the 3 bond funds currently, based on Broker Finance allocation, the blended return will be 4.1925%, which is slightly lower than the 4.2% that Broker Finance gives you during the qualifying period. Given that we're already at the peak of the interest rate cycle, it's only a matter of when rate cuts will happen and how drastic or big they will be. If you look for clues in the Fed dot plot, there's 1 expected rate cut to be scheduled for 2024 and 2 more expected rate cuts in 2025. Given that bond markets are always forward-looking, any new bonds issued will likely be at lower yields than before. This will automatically result in lower overall return for Chocolate Finance's bond funds, which means that Chocolate Finance has to continue using their own cash to sustain a 4.2% return. So with that said, I don't think Chocolate Finance will continue burning cash after the qualifying period, and it's not financially sustainable or feasible in the long run. So having reviewed Chocolate Finance, how does it compare to other options in the market? Well, to be fair to Chocolate Finance, I think the 4.2% return is one of the highest, if not the highest, in the market. It comfortably beat products such as Money Invest or Flip Money Market Fund. It also beats Momo Cash Plus if you exclude the promotional 6.8% that new users get for the first 30 days. So with all that said, should we put money into Chocolate Finance? Well, I'll be just saying, make hay when the sun shines. Personally, I'll put not more than 20k into Chocolate Finance. This is to take advantage of the 4.2% return on the first 20k during the qualifying period. Once the qualifying period ends, I'll then reassess whether Chocolate Finance returns remains the best among all similar products in the market. Now, if you're interested to put money into Chocolate Finance, use my referral link in the video description below and sign up via that link. So full disclaimer, I get $5 when you sign up via the referral link and transfer funds into Chocolate Finance. If you do not sign up via the referral link, you'll be placed on a wait list until Chocolate Finance really accepts new customers.